right, today in course number 2, we're going to dig into the financial health assessment. So, this is really where we're going to begin understanding sort of where we are in our finances. We're going to evaluate how to create a net worth and understand the difference between assets and liabilities in this process. So, by the time this course is over, we'll actually go through the step to develop our net worth. I can't wait to get started, and let's go. All right, today we're going to go into what a financial health assessment is, what we need for the financial health assessment, and how we actually create a net worth for ourselves. So let's get started. First, what we will cover today is just the importance of it. Why do we need this? Why do we need to understand where we are today? And it's really to address the things that we need to address first. And this will help us in that process. And so then we'll go into sort of what you need in order to have that financial health assessment and conduct that for yourself. We'll talk a little bit about sort of the practice and personal intersection because your practice is potentially an asset that impacts your overall net worth. And so we need to understand where it's placed in our overall financial picture and how to manage both. And then we'll determine where to focus your efforts. Through this process, we'll be able to understand what issues are at hand, what we need to address, and what we need to increase on the asset side or decrease on the liability side. And that's really the goal. And then we'll discover any other insights that you can glean when you're evaluating your own net worth and financial health assessment. Before we get started, of course, for extra tips and additional guidance, go to thinkingcapfinancial.com/newsletter, sign up, and you'll get some personalized advice there. YouTube, I'm at Thinking Solo. LinkedIn, I'm at my name, Ryan DeRusso. Make sure to share this course. We're growing wealth together. We're building wealth in the private practice space that cannot be done without sharing this course. And again, this is the most important video at this point in the course. So make sure to watch the whole thing. Don't jump around. And in my suggestion, I sound a lot smarter in 2 times speed. So feel free to watch it and then go back if you need to focus on one specific part of the video. All right, conducting a financial health assessment. How do you do it? First, you need to understand what a net worth is. Essentially, a net worth is assets, all the things that are working for you, minus liabilities, all the things working against you. And with that, we create a net worth. But that obviously leaves a lot of questions. What's an asset? What's a liability? And how do we evaluate those? And so we first need to understand that. So asset is anything that you own that has value. This can be down to, depending on how narrow you want to get. It can go from your house to a pair of shoes that you have, or your clothing, or anything like that. All of that would technically count as an asset for you and would go towards your net worth. Often when we're talking about assets with clients and stuff like that, we're talking about savings accounts, we're talking about checking accounts, investment accounts. So if you have a 401k, what's called an individual retirement account, or an IRA, a Roth IRA, any of those types of things are going to go into the asset side of the ledger. Property, like your home, that would go under that. If you own your the place where you conduct your therapy practice, that could also potentially go under that part of the ledger. And then any other thing that has property or value that could be sold, like jewelry or rare baseball cards. You have to be careful with these things because putting value to these things requires a willing buyer. And if you don't have a willing buyer, then the two values might not match. And without a matching price, then the thing doesn't have an actual value. And so what can often happen is people will have this jewelry set that they think is worth tons of money, but when they actually go to buy, it may be worth thousands to hundreds of thousands less than they expect. And you want to avoid that situation. And so you need to make sure you're evaluating things correctly. Is my practice an asset? And that really depends. This is a key question that you're going to have to answer for yourself. The way to answer this is to determine what would happen if you left your practice today. Would it cease to exist, or would it continue on without you? If it could continue on without you, then it's potentially an asset that can be valued in some way. However, most folks that are at this stage or early in their private practice ownership, they may not have any value in that private practice because it couldn't survive without you. It's essentially an income source instead of a business asset. And so when people walk through my door, I almost always value that asset at zero at the beginning. It's only once we have a buyer that has a hard number behind it can we put an actual asset value behind it. And that's just because of the nature of the business. We don't know if that therapy business will ever be sold. We want it to be sold in some cases, but until we have that hard figure, we can't really put a value behind it and inflate our net worth in that process. So on the flip side, what is a liability? It's really anything that you owe more than, say, a month. So anything beyond what would be in that month's credit card bill. And so for financial planning purposes, which is where I'm kind of speaking from for this, things like the mortgage, student loan, something that therapists have quite often, credit card debt, because once it goes past that month, it's now accruing interest, and therefore it's now a liability as opposed to just an expense for the month. Auto loans is a common one, and any other loan. So you owe your parents $5,000. That could be a liability. You've consolidated your debt into one loan. That's potentially a liability, or a business loan of some sort. That's a liability. And really anything else that you owe that would fall under that liability umbrella. You want to be careful underpricing these things because it's about what you owe today. You may be thinking, I have $5,000. I'm going to, get rid of this liability at the end of the day. But then if that never happens while you're calculating your net worth is going to be wrong. And so we want to make sure that we're actually doing this correctly and evaluating our liabilities correctly. So how do you do all this? Like, figure out sort of what your assets are, what your liabilities are. You're going to need a few documents. First thing you're going to need is any statements that are available to you. So your mortgage statement, your credit card statement, your any other loans that you have, those statements, auto loan, that sort of thing. Online accounts are a good source for this because they'll have a full recap of the entire life of the loan or the asset or anything like that. If you have checking accounts, savings accounts, you're going to find them there oftentimes. When it comes to less tangible things like the jewelry or the baseball cards or whatever, you're going to use either marketplaces or professional valuations. The same is going to work for your business. So if you think you can value your business as an asset, you're going to base it off of what is available in the marketplace. Now, the concern is, again, you may overprice that asset in that space because if you go on eBay, what you're seeing is the seller price. You're not seeing the buyer price. And so we don't actually know what the buyer is buying it for in a lot of times. And so we need to understand what the actual purchase price is in these situations. So the danger is to overprice if you're going to a marketplace or professional valuation for these things. So just be careful there. And then you can also use online calculators in certain situations where you have investments or anything like that that need a specific valuation. One of the ways that we do this is we need to kind of move our information that we have gathered at this point to a net worth calculator or something that's tracking our net worth over time. And so let's do that now. I have two calculators that I've provided for you within the show notes. And one is just a good one that you can find online. It's through AARP. I think it's very smartly done. One, you can include some asset growth into it. You can include some liability growth into it, and then incorporate your different property values and liabilities, which we'll go through in just a minute. And so this is really good, particularly for one-off situations. So if you're not tracking your net worth over time, but instead just trying to see where you are today, this is a good way to do it. You can just use online calculators to do so. And so in this case, let's say we're going to include an asset growth of about 7%. Why is that? Because our investments are growing over time. Our liabilities, as we're paying them down, are decreasing over time. And so that's why I've put a negative 3% on the liability growth, because we're paying them down. Even if they have interest, we're paying them down overall. From there, we're going to start incorporating our assets. And so let's say we have a home of $400,000. Let's say we have we don't have any rental property at this point. We have an automobile that's the Blue Book value says, let's say $10,000. We have another vehicle. Let's say it's on its last legs. It's only worth about $2,000. We don't have any jewelry. We're not going to include household items in this because it's going to get too complicated. For the retirement accounts, let's say we have like 25,000 because we're early on in the process. The bonds, stocks, as long as it's in a retirement account, you don't need to separate the two, just as long as you know kind of the general number for this. And if you have some life insurance where it's getting cash value, make sure to put that in there. It's not always the best type of life insurance, but sometimes people have it. And then any checking savings accounts would go in the cash section. So let's say you have 20,000 there. And then within the retirement accounts, I would include the taxable accounts. You can either include it in the retirement accounts, or you can separate it in the bonds, stocks, mutual funds if you wanted to. That gets kind of a little more complicated, just so you know. But if you're talking about sort of just the investments, if you just want to say, right now I have about $30,000 invested, that's really fine for the purposes of this at this point. We'll get deeper in another video about your specific investments and what they all mean. Then you want to put in your liabilities. And so let's do that. If this will pull down. Okay, and let's say we have $270,000 left to pay off the mortgage. And so that's what we still owe on the house. Let's say there's about $6,000 left in the auto loan, the one auto loan. The other auto loan, let's say we have none. Student loans, let's say we have $120,000. It's very common in the private practice space for therapists to have student loans that they're still paying off. And so that would be very common. Let's say there's a $10,000 credit loan, and let's say we owe our parents like $3,000 or something like that. And then we would put that there. And from there, we will get our net worth. And let's see. View results. And you see your current net worth is $51,000. And total assets of $460,000, total liabilities of $409,000. And so what I am seeing here is that you have a good size of assets, but a lot of that is built within the home. And because it's built within the home, it's not necessarily an asset that you can access very easily. Meanwhile, you have a good amount of liabilities as well. That's pretty common because, one, in order to own a home, you likely have taken out a mortgage for that. But then you also have the student loans in this case. And because of the student loans, it really decreases our ability to maneuver and that overall sort of net worth. And so what is this telling us? That maybe our debt situation is a little worse than we had hoped. The good news is you're on the positive side of the net worth, pendulum. But on the bad news is that we still have a good amount of debt that we're dealing with, but at least we know the sort of debt that we are dealing with. And what we need to start doing is kind of tracking this over time. And so you can do this and say, okay, well, year one, if this continues to grow like it's supposed to, and we still see liabilities decrease like it's supposed to, then our net worth is going to be $534,000 within 10 years. That's fantastic. But is that reality? And the only way to know if that's reality is to start tracking it on an everyday basis. Not an everyday basis, but say like every month or every quarter or every 6 months basis. And so I've put together a net worth calculator that you can download as well in the show notes. And here you can put together your own net worth, and you can say, hey, okay, I have a checking account. It has $10,000 between, or let's say $3,000 for the checking, $10,000 in the savings. cash value life insurance, 3,000. I think we said between the 401k, 403b, let's say there's about 20,000, and then we have 5,000 in a taxable account. And then we have a 10. Well, this is both cars, so it'd be about 12,000 for the total of the car value. And then that's about it. And then we go to liabilities. Oh, we need the house. So real estate, that will be 400,000. And you just want to go through this, line by line, using those statements, using your online account, and figuring out the actual value for these things. I'm just making up numbers here, really, and it'll vary by person by person. But the more we're recognizing what's going on, the more we're going to know. And the only way to know is by looking at those statements on a regular basis. And so that's really what I'm doing here. So I think I said 270,000 in the example. If you wanted to do rent, if you're a renter, you can do that because it's a cost that's going to continue. You don't need to. It really is dependent on the person whether they want to include that in their net worth or not. But for those who plan to rent long term, you may want to incorporate that in the net worth just because it's never a liability that's going to go away. It's always going to be there. And so that's perfectly fine if you do that. I think for the auto loan, 6,000. Student loan, 120,000. Let's say 10,000 for the credit card debt, a personal loan of 5,000, and we get to about net worth 42,000. So the numbers are different, but you can see the overall sort of thing that we're doing here and trying to get at. You can actually take these numbers then and track this over time, because you can just say, let's copy this, copy, and paste. And this is net worth. Let's say this is 701, and this is going to be 1001, let's just say. And you can just do the whole thing over again. How has things changed? Or now it's $5,000. Now this is $12,000. Now these have gone up, or the 401k and the IRA have gone up a little bit. So now it's 24,000. Maybe the taxable account went down a little bit, so it's 3,000. Your automobile value probably dropped a little bit, so let's say 11,000. Oops, I had an extra zero. That would be nice, but not the case. And then let's say the real estate value has gone up, so now it's 420. 20, 1, 2, 3. And so that's a little higher. And now let's say this is 268,000. Student loans, 119. Credit card bill, you've done a good job of reducing that, let's say. And the personal loan, nothing's changed because it's to the parents and you're trying to focus on things with a higher interest rate. So now you see the net worth is only 5. Oh, that's why. Typo. 119. Okay. And now the net worth is 76,000. And so the more you do this, you can actually see the growth and see the value that you're doing and bringing to yourself by addressing some of those liabilities or increasing those assets. Because it's not just about decreasing things, it's also about increasing things. And when you recognize this, you understand sort of where you can focus your efforts and what's going to bring the most value. And when you're kind of laying it out like this, even more so, you can really dig into that one specific thing, because you can say, okay, I have $4,000 left on this credit card. Maybe I want to pay it all off now. What's the impact? Well, it's not going to have that much impact because it's going to take away $4,000 from your savings account. It's going to net. Granted, you're not going to have the interest anymore, so that's nice. But for right now, it's not necessarily the thing that you have to do or anything like that. But what if we say, okay, we're going to keep that we're going to change this to a 0% interest rate card, so it's not growing anymore and it's going to reduce a lot faster. Well, it could be the next time you do this net worth valuation that the value of the credit card is now zero, and that would be huge because now it's increasing 4,000. You're no longer having to worry about the interest rate at that point. And so that's a really good step, and you can understand that as you dig into your net worth page a little bit further. And again, how you do that is going to depend on how you or what you want to focus on and how you want to grow and the capacity you have for growth. So it also includes the income and the expenses, which we will get to shortly. So it's not meant to just be a decide all. Instead, it provides some context to what you're dealing with today and how you can manage things moving forward based on the work that we're going to do on the income and the expenses. And when you're able to put it all together, that's where the budget is going to become really valuable, because it will manage the income, expenses, and within that budget, incorporate the things that you want to do on the net worth table. So what's the recap of this? First, you got to understand what the difference between the assets and liabilities are. Recognize those differences. Recognize the difference in how to evaluate these things, because if you're not evaluating them correctly, you can't take a proper process to address them. Make sure to fill out that calculator and get started. See where you're at. You know, for some, you'll be negative net worth. That is okay. It is totally fine. With student loans in particular, with credit card debt, it's very common, unfortunately. And so you're not alone in that process. It's not about sort of looking at that net worth and saying, oh, I'm winning or, oh, I'm losing. It's about knowing where you are so we can address moving forward. And also we can continue to track moving forward. So as you're taking steps like this over time, you can start seeing that net worth growth grow higher and higher and higher and encourage further action on your part. Make sure to track over time for that purpose, and then recognize where to focus. If you see that your asset or your liabilities are holding you back from growing your assets, maybe it's addressing that. If you see that you're low on liabilities but you have no assets, maybe it's really focusing on growing those. But we don't really know until we see it all as a full picture, and that's really what the financial health assessment helps achieve. Again, for more, join the newsletter for additional guidance and advice, thinkingcapfinancial.com/newsletter, and get started by filling out that net worth calculator today. Make sure to send testimonials at thinkingcapfinancial.com/testimonials. Tell us how the net worth efforts are going and if they've helped you at all, and then get started today. I can't wait to hear how it goes.